So thank you for the invitation to have me back. That's very kind of you. I didn't expect that, obviously. It's a little bit now for something completely different, and I'm also standing in the way of the drinks. I'm very aware of that. So I'll try to keep it a little bit perhaps entertaining, but it's more about the economic case of decarbonization or carbon neutral, if you want. Some investment opportunities that we see. We have, by the way, invested in carbon capture 8 years ago in a company called Swante, which recently was invested by Chevron with a size to scale it up. And we've done some other, disruptive things well before the curve, I think, concentrated solar, fusion technology. So we've been either stupid or stubborn enough to do this for already 20 years. And we keep going because we think now is perhaps the decade that, finally we'll have some good outcomes also. So let me skip this. The reason I pulled it up is I take every opportunity to remind all of us, but this audience, of course, needs very little reminding, that there's actually something happening. And it was the annual review, of course, here that wasn't really encouraging and sort of the incentive to act. And the reason I still pulled it up, still put it in there, and I will go very quickly and then go to the real story, is that I did a trip also in North America. I was in Houston at a conference and also visited most of the oil and gas related companies, so the EPCs and ExxonMobil and Vitol and what have you. And my overwhelming feeling when I came back is that two things. We have time, that was one, and second, we'll solve it somehow, and it will happen here. That was the third thing. So that was my sort of, I was really puzzled a little bit. Quite senior people that you talk to. So let me get to the idea of, I'll come back to this one, to the idea of we have time. So, and these are a few, it's 4 or 5 slides that tell a narrative, so bear with me, please. First piece of the narrative is we don't have time. So you want to be carbon neutral by 2050, you need to be carbon negative by 2030. Most companies, because you're in these sectors. So let me go back. These sectors. So these are the sectors where there's a lot of text in the subtitle because I can't memorize all these data, so you can read through it. But the bottom line is carbon neutral is a huge mega trend. There are 84 of the top 100 companies in the world, MSCI World 100 Index, that have announced carbon neutrality, mostly by 2050, scope 1, scope 2, sometimes scope 3. Microsoft as an outlier, historic emissions, but of course that's an outlier. So there's all that. Now, and then, so this is the first part of the narrative. You buy it or not, but that will be a good for the drinks, of course. But that's the first piece of the narrative. Second piece of the narrative is, you think this can all be solved overnight, the technology is already available, but our piece of this narrative is a large percentage of these technologies are either in early adoption. I would also, by the way, bucket green hydrogen in there, going through a cost curve. And a part of these technologies are not yet commercially available. I would bucket, for example, carbon utilization in there. So those are. So you could argue there's a need for innovation. There's a need for the type of things that we do. That is taking it's venture capital. So you take things out of the lab into the real world. So that's the second part of the narrative. The third part, and that is encouraging. You see it shine through in some of the presentations just now, is that companies are sort of shifting their strategy towards, hey, what kind of products and services are we going to offer to help our clients to decarbonize? I mean, it's really that simple. And it's really striking that the whole narrative has shifted over, I'm not going to say in the last year, but let's say in the last couple of years, from a discussion around sustainability as a cost, with all these sort of negatives, if you want, that you see here on the left side of the slide, but towards value creation. But you have to have a strategy in place, obviously. And then if you think back of the first slide, when companies announce, there are economics papers around it. When companies announce carbon neutrality, the share price barely moves. So that's quite interesting. So my favorite explanation is that the analysts just sit there and say, yeah, sure, but we'll ask you next year what's happening.
What you're doing.
yeah, what happens with your capex? Are you consistent with your targets? What does it mean for your portfolio? What does it mean for your existing legacy assets, etc., etc.? So the heat is on, no pun intended. But so that's the next part, and the last part of the narrative is, our friends from McKinsey came in handy for us at least, because there's this huge addressable market. So, you know, and even if you take a few trillion off from the big number that they are saying, and it's across all these hard to abate sectors that you see here. So that's the background, and there's one strategy slide here for those of you who are with companies, maybe I hope interesting. It has helped me to have a lot of debates with company executives. Let me first explain it quickly. So two relatively simple definitions that you can see. You may ask why knock off the 10%, but that's because you can never dedicate your whole profit to new things, right? So that's one. And then divided by scope 1. Why? Because you make it comparable. Most companies report on scope 1 emissions, and then divided by how you call it, that is the critical carbon price, and then available capital, also relatively elegant definition, same basically as a measure of capital to invest, right? So that's the, now what's the significance, I think, of this slide? If we have put thresholds in there, so $200, so what's the logic behind $200? The logic behind $200 is if your business portfolio can support a carbon price of $200, you can buy yourself out of the problem. You could do carbon capture and storage. Yeah, you can afford that. What's the logic of 20%? The logic of 20% is in a typical strategy cycle of 5 years, theoretically again, you could renew your business portfolio. So that's the logic behind the 20%. Now it becomes interesting, because where are you? You know, where are your clients, for example? You know, where are they? Are they a steel factory? And I will not go into names, of course. We've done some analysis on public companies around this. But are you a steel company that operates on low margins and has high emissions? Then your option set is very different than that you're a diversified group with a very strong balance sheet. There is a chemical industry in the Netherlands that has transformed from coal to base chemicals to specialty chemicals to life science. Their business portfolio can support a carbon price of 1,350 euros. And if you would include scope 3, it would still be 350 euros. Mm. So, in other words, they're completely resilient against the carbon price. One of our investors, this is public, obviously, is LyondellBasell in our carbon neutrality fund. Their situation is a little bit different. So I'm just saying, are you working on efficiency, decarbonizing your legacy assets, or are you really asking yourself what position can we take in new markets and new products? Now let me go. So this was presented also last year, because fundamentally it hasn't changed that much. But I will use the rest of the time, and that's hopefully interesting for you to explore a little bit how we think about some of these areas as an investment opportunity, because that's really the title of this piece, right? Now here there shouldn't be any surprises. This is sort of high level what we see as the options to get to carbon neutral strategies. So, you know, material substitution, efficiency, alternative fuels, carbon as a resource, circularity. Some of the examples will be about circularity. And then the whole area of negative emission technologies, and then carbon markets as an enabling factor. So this should be, for this, you know, the people here, this should be clear. Now let me go to some examples. And so what we've done is we've looked at all these sectors and taken the analysis one level deeper, of course. So what are the options per industrial sector? But I want to talk about circularity a little bit, because I don't know if you captured it. I think you did. We just touched upon it. But Systemic has done work for the European Commission, and there's an estimate out there that circularity can contribute to up to 56% of the emission reduction target of the European Commission. 56%, think about it. And of course there are some additional benefits of circularity that I probably don't need to explain either. So we're quite interested in circularity. But let me give this example to show you how it then works for us, for a venture capital firm. So first, this is examples about steel. So first you ask yourself trends and drivers. That's classical, of course, for an investor. You need to know what's going on and is there an opportunity set. And in this case, without going in too much detail, there is the process technology, is one part of it, electrification actually. And the other part of it is the availability of feedstock, which is always a critical question in circularity, of course. Availability, quality, price, etc. Now, if you put that together and you get a feel for, there may be something here, then you need to go deeper, obviously. And I just want to say here at this point that this is almost like the theory of constraints, which is like decades old, Goldratt. Because every system, and particularly in circular economy, you have techniques to map out how a material flows through the whole supply chain. And if there's a constraint, that's good. That's good from a perspective of a venture capital investor. Because if there's a constraint and technology may be the solution, then you start to think about an investment thesis, right? So here the constraint was, again, without going into the technical details, but was two parts. It's the sorting technology, and it's the contamination of the steel with copper. And you think about how a car is shredded, you can easily imagine that those are two problems, right? With the, so what we did through a series of, let's call it initiatives, we have quite a strong academic network worldwide. Without going in all the names, but NTU, for example, Singapore, Stanford, Delft University, Waterloo, Carnegie Mellon. So what we do, and applied research centers. So what we do is we put that question out. We say, we have identified a constraint. Do you have an idea for a solution? So, and then, you know, we look at that and see if it's investable. Sortera actually came out of RPE, our involvement with RPE. And we were introduced to the technical founder. We invested, the rest is history. This is a star company, actually. And for those who have more financial, this isn't a talk about investments, but it's been invested 2 years ago. It now Series B, Breakthrough Energy Ventures is invested, and it's a 10x in 2 years. So, but it has a very specific profile, this investment. It's not like some talks today where like, hey, we need money from the government, because we have this huge factory to build and we have a first loss. It's not that. It's really sort of fundamental economics behind it that drive such an investment. The other one is really cool, is more like a chemical process actually, but still with very acceptable capital intensity. And those together will actually unlock this opportunity. Now let's go to another example. This is also a sector, obviously, with a high sort of need. Somebody said existential in the previous talk, I think, or the one before. But it's true. If you can't decarbonize, there's an existential question around your industry. So, but let's go to circularity. So again, trends and drivers. Now, without going into all of them, but it's very interesting that you have drivers on the decarbonization side, but also on the material side, on the supply side, and on the broader environmental side, you know, like landfills and all those things. So there's so many drivers that work into the same direction. Here, by the way, so what we do then is to describe what needs to become true. So what is a good investment case, basically? What are we looking for? Similar technology, we put it, or similar methods, we put it out there and collect the best ideas. In this case, the idea, of course, this is how then ultimately you want it to work. I stay away from the details, so that can be for the drinks, because then we go into aggregates, fines, ultra fines, sorting technology, heating technology, and etc. But staying away from those details, so really you want to close that loop and increase, of course, the amount of recycled content in new materials. And we found, sorry, I put it in here, probably because I thought it was a good example for framework. But it's a very busy slide, and you've seen already very busy slides. So will you take face value that we use frameworks that are sort of intelligent to sort of select the best proposals? And then and this came out of the university where I have my office actually, in the Delft University of Technology. And there is and that's also a little bit to your question. There is a group that takes material for material and then follows our logic almost. Like, Why is a material downcycled? Why is it not upcycled? What are the constraints? Can technology be the solution? And what is the science behind it? And can we work on that science? So it's a little bit different. It's fundamental, but still with an idea of market, right? So that's I think, or problem at least, a problem statement. And there is a group in Delft that does that. Professor Rem, Peter Rem. And he was particularly working on this step. The first step is mechanical. It's still innovative, and there's a lip system around it for quality control and etc. But this was really the innovative bit. It's a vortex with a certain heat profile, and it breaks the material at the boundaries. So you get these very clean fractions. So like I said, aggregates, fines, and ultrafines, and they all have a value in the market. Payback, don't quote me on it because we're still working through it, but it looks like the metals are extreme, I can tell you, the steel that I showed you before. This one, I'm going to say, will be a couple of years, maybe 1, maybe 2, but it's still very acceptable. If you combine that with a capital intensity of, let's say, give and take between 5 and 10 million with every box, then it becomes suddenly very sort of financeable. So last example, if I may,
Please.
Because we've talked about carbon capture, of course, and I would add storage. Then perhaps you need to do something, perhaps with the CO2, and CCS. As far as I know, I'm not the expert at all, but you need specific conditions, like a good concentration of quality sources. Some existing infrastructure for transport, a carbon price, and some geological structures, of course, to store it. So our thesis around CCU is that it could provide an interesting opportunity. Because if we're going to capture more, and if the thesis is correct that storage in the geological structures needs certain specific market conditions, and we are going to defossilize, we need to get the carbon somewhere, So you think there may be something there. And what we typically do is then build these kind of taxonomies, just to, first of all, to understand what we're talking about. But then the thinking is relatively the same, What are the constraints in sort of why, first of all, is there a market, potential market? I think I already spoke to that. But then, of course, what are the constraints? And a lot of engineers here in the room, so probably don't need to explain that it's a bit of an uphill battle thermodynamically. But there's another thing that is about the products that come out of it, and the time of greenwash are of course over. So you need to be very selective in how you think about carbon utilization. Now we've gone through all these pathways and asked ourselves similar thinking: what are the constraints in this system? Is technology the solution? And is there something we can find that is unique and defendable, and et cetera, et cetera. So we've gone. So you will excuse me that I'm not going to present all the investment theses around CCU. I hope you can appreciate that. That's a bit of the IP, of course, of our firm. But know that it's there, and it's a very interesting area. Last word on this, well, similar, you have frameworks, you need frameworks to evaluate options and sort of investment targets that you look at. I think I'm almost at the end, yeah. And the other thing, of course, that to identify good venture opportunities, we a little bit black and white, but we don't take any market risk. We don't like market risk. We do take technology risk. I hope you appreciate the difference. Technology risk, unless it violates laws of physics, but technology risk you can work with. If you have a good group of founders and engineers and a research program, you understand which steps need to be taken and how it can be funded. Market risk, on the other hand, is very difficult to manage, because if there's no demand for your product, then it's obviously not a good investment. So we spend a lot of time on understanding what problem does this solve, and is it a problem that will stay? Is there enough value as opposed to the cost, and etc. And this is our quick take. It's not rocket science, but our quick take of what sort of early opportunities could be in carbon utilization. Maybe a last word, if you allow me. But that's more to, it just struck me that a few of the speakers today said, yeah, I come back to the large projects and the money and the economics. So we need money from government because otherwise it will not fly. So I had two thoughts around this. First of all, I think that in our profession there's enough opportunity in this mega trend of carbon neutral that doesn't require any government support. Jury is out if carbon price will be part of business models, ultimately, could be, you know, so I'm not ruling it out. But the second thought I had was more philosophical. If you look at as fossil fuels, we all know that has been priced for a very long time at the cost of extraction, actually. And the externalities are barely priced in. First point. Second point, I look at my own country, but I know the data from my country. I don't know the data from this country. There's a lot of subsidies going into the sector. You know, there's no tax on aviation fuels, just as an example. Whereas we, certainly after the war in the Ukraine, we you know, and again, Netherlands, the price for gas will go up. There will be more, even more, and I think it will be like 30% is the cost of the product and 70% is tax. So I just wanted to make that point that, yeah, okay, but something has to give. You know, you cannot sort of have your cake and eat it and say, yeah, we want to become carbon neutral, but we still want to have the money from the government and still want to have the cheap gas. I mean, that's not going to work. So with that, thank you for your attention.
Great.
Oops, that is scary.
Great, thank you. Have a seat. Take questions from the audience in a moment, but I'm going to take the privilege of being able to kick off with one. Somebody over lunch said there are perhaps really, to get going, you need different kinds of money. Money from government brings certain characteristics and advantages. Money from a VC brings another perspective, certainly a rigorous testing. And you need money from partnerships with big corporates because you need some of their insight and experience. I wondered if you had any thoughts in that direction, and with some of the projects that you've invested in, at what stage does it become, from your point of view, also very valuable for them to engage with those other sources of investment?
Yeah, a super relevant question, first of all. And so there are a couple of dimensions to this question. One is the corporates. So the corporates, the mature corporates, they have corporate venture teams, and we work with them. So we do the de-risking basically at the beginning, because if you start to work with the technology, if you have a client, for example, they want to make sure that the supply chain is in order, the safety is in, you know, everything needs to be spotless. And you can do that with the reputation and the operational model that you have. But startups need to help to get to that point. Mm-hmm. So that's the first, so the CVC. The other point that is really significant is that there's a lot of growth capital now in the market for climate. Yes. BlackRock with Temasek, General Atlantic, TP Rise, Amazon, we are also co-invested with some of them. And somebody also mentioned the value of death today. And it will be much easier, in our opinion, to overcome the value of death because these people, they want to invest 50, 100 million. They want to have like 10 to 15% ownership, but what they don't want is technology risk. Mm. So now these innovation chasms are easier to cross.
Any questions coming from the audience back there? And okay, you're first.
Hello, Mariam Sharifi from High Ventures. I have a question around feedstock and circularity. I'm wondering how you can prevent the price of your feedstock increasing once you've found a use for it in line with demand.
Yeah. You clearly have thought about this. So it reminds me of tire recycling. That looks very cool. And then certainly you have this carbon black, and there is a demand for carbon black, and there is a price of carbon black unless you flush the market with carbon black. So that's probably where you're driving at. So. Well, I mean, it has quite an obvious answer. So in the steel case that I presented, the demand side is huge, and sort of the supply side you can keep going for 10 years before you hit that point of and on the pricing, so you start with enough cost to value. Sorry, this is a bit technical, like VC, but you ask so. But you start with enough cost to value, and then there in some of our investment there's an assumption that there will be a green premium down the line for the product, and that will be factored into the materials. So that's the way we think about it. But it's a very relevant question, obviously. I mean, but on the other hand, if you think globally about it, think about in Europe about our materials situation. Think about the metals, for example. I mean, before you hit that point that you're no longer needed to supply the material, that's a long way off.
Yeah, just on the fossil fuel pricing. I mean, I think fossil fuels are priced on the production cost of the marginal producer, not the average production cost. And I don't know what the lowest cost producer is, but it's pretty low. So, you know, your $200 a ton sort of number at half a ton roughly per barrel gives you quite, gives you $100 of makeup. I just wonder if you think that actually there's enough low-cost production out there ultimately to be able to afford to pay for direct air capture, and people would still find the product purchasable for its premium value.
Yeah. So just for clarification, the remark I made was, you're right, of course, it's priced at cost and then sold as a margin. I mean, that's not what I was referring to was the pricing of the externalities into the product price. So that was what I was referring to.
Yeah. So what I'm actually saying is, if you take the low cost producers and add at least the CO2 externality by bundling it with direct air capture and permanent storage, I wonder whether you think there's enough low cost production out there to actually, with your $200 a ton, which is a great number,
well,
to get a market.
And the $200, also for clarity, was a threshold to moderate the discussion around what is your going in position in this problem. Yeah, okay, so that was not like, and on direct air capture, I will honestly tell you, and it would be a great discussion to have with some of you over drinks, we don't have a thesis yet. Mm-hmm. No. We have some directions, so we have some direction on the cost, ultimately. We have some direction on maybe combining it with decentralized, electricity generation, maybe as a pathway to fuels. Mm. So there are some thoughts, but we don't have a strong thesis around direct air capture right now.
Robin first, and then. Okay, sorry. Let's go.
Hi, Paul Skinner from NSG Pilkington. Fred, do you think there's a window for this, investments, green investments? We think in terms of the glass industry, maybe a low carbon version of our glass. The commercial opportunity for that is maybe 5-6 years, and then the expectation is all glass will be low carbon. So in terms of investment into technology to get there, do you think it's the same sort of time period, or is it longer than that? Is it up to 2050?
Well, I wouldn't permit myself an opinion about the strategy of your company, obviously, but I can make some general observations. One, what I presented, if you set a target, your investors and the institutional investors, particularly also in Europe, there's a growing alliance of these type of investors that will hold you against it. So they will start to ask you, how aligned is your CapEx? How aligned is your innovation? How aligned is your corporate culture, actually? Do you actually track your progress? Do you have a system in place to understand what your options are and what your sort of optionality is around carbon neutral? They will start to ask you. Mm-hmm. So that's one pressure that you'll get. The other pressure, that's where I won't permit me an opinion about your industry, but in general, is that if somebody comes along that has a greener product, ask yourself what will happen to your company, right? So do you want to be leader, or do you want to be the last man standing, or do you want to muddle through and see what happens? That's up to you, obviously.
Perhaps a side question here and then to Robin. We're starting to have lots and lots of attempts to classify green and there are all sorts of initiatives you can join to say that you are a company that's got a net zero commitment. There are so many of them that it's now becoming a bit of a forest. How do you relate to that and to the rise of sort of climate risk modelling around corporates? Because this forest of standards and models is being used by a lot of people in the finance sector who have no other way of accessing that information. Yeah. But my understanding is it's a bit of a mess at the moment. Do you, with your own approach, simply set that aside, or do you try to have a dialogue with those different...
Yeah, to some extent it's set aside, as the carbon price is, because it's something, you know, we look at is technology unlocking this opportunity, is there enough cost to value, etc. On the other hand, interesting enough, we have identified carbon analytics as an investment area. Yeah. So that's the flip side of it, because you have this pain point that corporates are saying, hey, we don't know where we are, we don't know where we're going, we don't know what our options are, we have limited capex, so how are we going to, what are we going to do, where are we going to invest? And that is quite interesting. So we have, so somebody may become the sales force of carbon.
Yes.
And I would love to invest in that somebody.
Yes.
But it could also be that it's already out there, you know, with the large software houses or the accountants. It's possible, but it's not trivial. It's very important to have that. Yeah.
Okay, and eventually you've got the law firms, the people who do mergers and acquisitions, and they want to know what liabilities are. Absolutely. Yeah. Okay, Robin.
Yeah, Fred, thank you so far for a wonderful discussion. But I want to ask a sort of philosophical question about the value of money.
This is going to be a great last question of the day.
We can debate this over dinner as well.
You're clearly ready for the drinks.
Money is a man-made invention, and here we're dealing with something that's really natural and actually existential. Why is it that we can't get money to consider the value of carbon?
Yeah. Well, you know, I had a discussion with, I was mentioning Systemic, and Systemic was founded here in London by Jeremy Oppenheim and Martin Stucktai, both ex-McKinsey. Martin has gone on to his next project, London. He's now in Munich, where he was former head of the McKinsey office, and he started an initiative to create an asset class, a nature-based asset class that is actually you can put on your balance sheet, and then ultimately it also becomes transactable, right? So he's thinking about, so he's working with satellites and God knows what, and all sort of algorithms, and I think it's a very interesting direction. I'm not sure if you were thinking about that, but how do you actually create an asset class around carbon removal? I mean, that's basically more the conceptual question. But there are people, that's the good news, and very smart people, Martin is a very smart guy, that are working on that with 30 people already. So it's a startup, friends and family, and they're working on that. So that's perhaps encouraging. And you saw, perhaps I flipped through it, but the whole removal side and carbon negative emissions, so not only engineered, you know, like air capture, but also nature-based, are integral part of our thesis.
Absolutely. Joachim wanted to come in. Could we get a mic to him?
So maybe a question for you, Fred, or for the drinks, or both. Building on the question from a friend from Pilkington, and you mentioned green premiums you take into the equation. When I look at the steel and metal sector, a lot of that is driven by the automotive industry, their demand on that. The automotive industry doesn't exactly have a track record of paying premiums. They have the opposite, actually. Yeah. Is there a risk that green premiums are not sustainable? Yeah. That they are just kind of luring us into this and then they start squeezing us, so to speak?
Yeah. Possibly. I'm not the expert on this one, because I consider that more as a marketing issue for the industry itself. So, but going back to the steel to steel, you're right. The pull comes from the particularly European automotive industry, right? Because they want to have the net zero car, and recycled content is a real contribution to that. Then you have the industry leaders in aluminium and steel, like for example Novelis.
Yes.
They're saying, we want to go into this direction. That's our promise to the market.
Yes.
And then suddenly you need the technology, right? So that is the pull.
That is the pull. But then we say certain in the automotive industry, they will already put up a cutoff line and say, all right, if you have a carbon footprint above this, we don't buy from you.
Yeah.
So you need to invest to get below that cutoff
Yeah.
line. And it's not that you get a premium, but we don't buy from you.
Yeah.
It's rather that. And I guess you think about this. I think it's something really to...
But what I'm saying conceptually is that we don't factor a lot of green premium into our investment thesis. That's conceptually what I'm saying. We're just factoring in the demand side, and then we look at the cost to value, and that's it.
So you're prepared for the car industry to bargain hard?
Yes.
Okay.
Well, I can tell you because it's the last year, but the paybacks on the metals recycling are very, very aggressive. That also explains the sort of the investments in the company.
And that's ballpark. I mean, the automotive sector as part of that versus other uses for steel.
Other uses also.
Other uses also.
But it now primarily driven by the automotive sector, but we anticipate that this will be more general. Yeah. And also across materials, because the technology, particularly the sorting technology, is also applicable for aluminium and ultimately also for plastics. So it's a it's a good play. Yeah, it's a good play.
Okay, well that's a very promising note, circularity, which I think had less attention than it needs as a very important topic so far today. A very promising note to wrap up on. Things are moving. That I take as a very clear message from all of the speakers today. There's a consensus on the direction of change. There's a lot of projects happening. There are investments happening. There are data analytics happening. So it's a proactive mood and situation. But there are some gaps. The skilled workforce is one of the question marks, no question. And that's not just engineers, it's making sure that Miguel's bankers understand what scope 1, 2, 3 is, because otherwise there are not enough bankers to talk to. And it's also in communications. The ability of companies to go out and talk about what they're trying to do in a way that's understandable to governments, that's understandable to environmental campaigners. That's not been a sort of primary job description for a lot of companies, but I think it's a growing job description. As we all deal with understanding increasing complexity, increasing options, new partners, there's going to be a lot more communicating in the business, both as a skill and probably in terms of sheer numbers of people. Tomorrow we have a presentation of the new Shell scenarios. We have a discussion on methane. We're going to look at renewable feedstocks. We will look at transport fuels, and we will come back to CCUS before we wrap up. So looking forward to that. Let's take some of the topics that have been opened today upstairs for drinks and dinner. Everybody, thank you very much, and thank you to all our speakers today.